very warm welcome to Namaste Web3 presented by Forbes India and Coindcx, making India Web3 ready, supported by Bharat Web3 Association. I'm Swati Shahi. As we gather in the vibrant city of joy, our mission today is to discuss building wealth with new age investment opportunities, which is the theme of this edition of Namaste Web3. We will hear from experts about new age asset class from India, including alternative investment funds, private equity, and investing in startups. We also aim to demystify the dynamics of virtual digital assets and highlight their potential as a significant asset class for both new and seasonal investors. Well, while we move ahead, we are proud to introduce Namaste Web3 to all of you here, which is an initiative launched by Coindcx and Forbes India a year back. This multi-cities roadshows are designed to introduce Web3 to the Indian community and showcase the many benefits it can bring to businesses, individuals, and society as a whole. Well, we've held roadshows across various cities and towns featuring the high-quality content and discussions from over 50 influential speakers. The response has been fantastic so far, with over 4,000 people registering and 1,500 actively participating in person. And well, of course, lakhs and lakhs of people through online channels who have joined us. So, well, it's time for us to now take a look at the journey so far. Can we have the AV, please?
As the tech world steps into an era defined by the transformative power of Web3 and blockchain, India stands on the cusp of making an indelible mark on this decentralized frontier. Leading this charge, Namaste Web3 emerged as a pioneering force to unleash the limitless potential of this cutting-edge technology with its holistic approach. Namaste Web3's mission operated on three pillars, fostering a neutral narrative that unites and inspires, celebrating the remarkable technical abilities of Indian Web3 entrepreneurs, sharing tangible Web3 use cases, sparking crucial discussions on regulatory clarity to fortify a secure and supportive Web3 ecosystem.
India's presidency of the G20 comes at a very opportune time. In recent years, particularly since the pandemic, the image of India has dramatically changed around the world.
Take it to every corner of the country, because that's where the magic happens. What binds us all? What binds all of us into one? Is the common challenges that we have in front of us.
India has phenomenal developers and builders in the Web3 space. Go-to-market from India can be a little bit of a challenge. Even Web2 companies being built out of India, solving for the world, did have their fair share of challenges.
The industry's response to this framework is very, very positive. In fact, people have kind of started lining up in offering solutions, in offering partnership, in offering skills. Skilling is again an area where we seek partnership and support.
Namaste Web3 has been on a remarkable roadshow, crisscrossing the diverse landscapes of India, spreading the magic of Web3 technology across cities.
When individuals will have control, a developer base of approximately 2.8, just under 3 million 2 years ago. It is also projected to have the most developers by 2023.
Blockchain technology expected to go from 3 billion in 2020 to about 39.7 billion by 2025. AI market 190.6 billion by 2025, growing at nearly 40% CAGR.
To empower and equip visionaries with the tools to navigate the world of decentralized applications, Namaste Web3 introduced 2 volumes of VDA policy books, Fundamentals and Guiding Principles.
Like right now we have visibility into finance, but there'll be something in gaming and there'll be something in travel, and I heard of very interesting use cases. So we don't even know of the use cases that will come out.
So these companies which are taking these incremental steps like getting into metaverse, for what is to
with all the events that we've been doing and all the cities that we've been going to and the kind of mix that we get into and the kind of feedback that we get with these events that we're doing, at least what we're doing is getting all stakeholders under one roof, And there's a lot of conversation, I can assure you, that is going on with this.
As Namaste Web3 charts its course to new horizons and cities, we remain a community-driven force, empowering individuals, fostering innovation, and propelling India towards global tech leadership. Join us at Namaste Web3 and be a part of the future of the Internet. Forbes India and Coindcx present Namaste Web3, making India Web3 ready.
Well, a round of applause for that, please. And well, ladies and gentlemen, you could also be a part of this journey. All you need to do is scan the QR code that is appearing right now on the screen on my left to join the Namaste Web Telegram channel. And for further information, do visit the Coindcx stall outside. And with that, it's time for us to kickstart the proceedings of the Kolkatta chapter. We have a very special address on embracing new investment opportunities delivered by Somnath Mukherjee, CIO and Senior Managing Partner Product and Research, ASK Private Wealth, who will be joining us virtually. Let's hear it from him.
Good evening, everyone, and thanks for being here and thanks for having me in this wonderful program. Apologies in advance for not being present there physically. I'm a Calcuttan myself. I'm a very frequent visitor to the city, but I had some personal commitments for which I couldn't be there physically, but very happy to talk to all of you, through Zoom. Extremely interesting topic and extremely interesting path. They say in China that the best benediction that you can give a child is may you live in interesting times. If you hold that to be true, then really this generation really lives in extremely interesting times. None more so than India. The kind of change, the pace of change that we have seen over the last 15, 20 years, accelerated over the last 5 or 10 years, has been just phenomenal. And that has given rise not just to visible changes in our airports, in our digital public infrastructure, in our roads, but also alongside that in investment opportunities and value creation that has happened for investors who have come in and participated in this growth. In fact, as we speak today, it is a rather more sanguine element to be confident about India's markets than it is to be confident about India's macros. India's macros will grow as well. In fact, we will continue seeing extremely positive high rates of growth for a long period of time, simply because our base is lower and we will continue doing pretty well, given that we have a good set of policies and takeoff points now in place. But our markets have clearly outpaced the promise of our macros. The reason for that is twofold. One, we are from a financial perspective, from financial services perspective, in the 21st century, very few countries have rivaled India in the sheer pace of innovation. A lot of people forget, before it became cool, before it needed blockchain to come in to the rest of the world, instant transfer of funds on an interbank basis was started by India way back in 2002, 2003 through first NEFT, then RTGS. Similarly, the Indian stock exchanges, National Stock Exchange went on to a fully screen-based trading system in the mid-90s when it started. For a very long time, the New York Stock Exchange was not fully screen-based at all. In fact, it became very fully screen-based only a few years ago. So India has been right at the forefront of innovation on the financial services front. And the new digital public stack comprising Aadhaar, UPI, Jan Dhan account has taken this to a different level. And therefore, there is a great amount of market infrastructure that is there, which presents great opportunities for India to create value, for investors to create value. And the second thing is just our scale. 140 crore people, even if 10% of that is a reasonably good total addressable market, a reasonably good estimate of a total addressable market, you're talking about 140 million people. 140 million is bigger than any country in Europe. Russia will be roughly around that size, but it'll, given its declining population, it's probably a little lower than 140 million now. So 140 million is a massive market. And we just scratched the surface, right? Only 10% of the population. Now imagine the kind of value that can be created with a TAM of just 140 million people. And that is what gives a greater degree of confidence in terms of India's markets. As I say very often, markets are a weighing machine of survivors. Macros, on the other hand, are a counting machine of everybody, not just the survivors, but also the losers and those who sort of fall by the wayside. As a result, we have a long way to go as far as the latter is concerned. But as far as the markets and opportunities it presents is concerned, we have a really, really positive outlook towards the future. A few things are playing out to support this hypothesis. One, look at India's market volatility. India is an emerging market, right? So typically emerging markets are known for a couple of things. One, they are typically more volatile than developed markets. But look at the case of India in the last 5-6 years. Our volatility levels have been at par with US markets, which is at great variance to many other major emerging markets and under massive variance to China, which has been extremely volatile in the same period. Part of the reason is that India is, along with China, is the only large emerging market that actually does not depend too much anymore on foreign flows for the fate of its capital market growth. Predominant amount of growth of India's capital markets is happening out of domestic flows. We saw in the year 2022 when the US Fed raised rates very, very sharply and in some ways quite unexpectedly at the beginning, and global markets, especially the US markets, corrected very sharply. Indian markets held up very, very well, very resilient, in fact. The biggest reason for that was that India's domestic investor confidence remained very high. You see that reflected in mutual fund flows, especially SIP flows. You also see that reflected in the growth of alternative investment funds, portfolio management services, and all sorts of different investment products that cater to different classes of investors. But the common thread that goes through all of them is that India's domestic investor base has been extremely confident of India's markets, and that domestic investor base has been growing literally exponentially over the last 5-6 years, as a result of which India's volatilities have started approaching developed market volatilities. The second thing that is extremely illustrative of a typical emerging market is quality of regulation. Generally, emerging markets tend to have quality of regulation that is significantly lower than what is to be seen in developed markets. But we've been extremely lucky to have regulators that are right on the ball, if a tad conservative at the margin, for a very long time. In fact, quality of regulation in India rivals most developed markets in the world, and certainly rivals any country in Asia. In fact, I would stick my neck out to say that no country in Asia, and that includes the developed parts of Asia like Singapore and Hong Kong, have as good quality conservative regulators that India has. In fact, one of the few markets in the world where the regulators are now on a defined glide path to looking at T+0 settlement on equities, tokenization of stocks. These are things that Web 3.0 are talking about in terms of exotic new instruments like cryptos. very few regulators around the world are looking at these things for traditional legacy investments like equities and bonds. But in India, that's exactly what is happening. The regulator has laid down a glide path to move towards T+0 settlement, tokenization of instrument, and that's going to happen very soon. In fact, it's a matter of months rather than years now. So both of them together has meant that Indian markets are in a very enviable position for investors to create value, to embed value out of. One side of that, and that's something that has to also be kept in mind, with reducing volatility in the markets, contrary to what the current frothy exuberance in the markets might seem to suggest, the broader market returns from equity investing has been coming down. The best, and if you take 1991 as the pivot for India as a country and Indian markets as a capital markets as well, the best 5-year returns that we ever had was actually just post the 91 reforms. So the first 5 years since then delivered mid-20s sort of returns from equities. But since then, that handle has been coming down. And the reason it's been coming down, there's a price to pay. There's no free lunch, as they say, anything. But the reason it's been coming down is because our markets are getting more efficient, our regulations are getting sharper, and our volatilities as a result are getting lower. The flip side of that is that the return handles that we get out of equity markets, notwithstanding the current sense of frothiness around certain parts of the market, are actually lower than what we have seen in the past. But that's okay. That's good news because markets are never about timing. Markets are never about getting the best. Markets are about optimizing risk for the return that you make, and more about time in the market than timing the market. The other interesting thing as a result of this that has come out is the significant proliferation of alternative investment opportunities. Part of it driven by the real economy, but part of it driven very, very seriously by the sheer risk appetite, both Indian as well as global, towards some of those alternative investments. Over the last 5 or 6 years, the biggest growth of investor interest has been in private markets, whether early stage, digital startups, mid stage, or even late stage of various types. We have seen various cycles in that. We have seen ups and downs, periods of extreme exuberance, periods of extreme pessimism. Last year, we had a bit of a funding winter for the startup world. But by and large, we see a significant uptick in investor interest in alternative investment ideas. It has become almost a sine qua non. It has become, you can't do without alternative investments in your portfolio. It's not national service. It is not because India needs to grow its, digital space. It's not because India has to be, all of that is true, but it's actually very, very extremely selfish, personal investing value creation reasons. These areas are the ones that have the potential to generate the spread over the vanilla listed markets, the listed capital market handles. As I mentioned, they have been coming down. They've been coming down because the risks embedded in them have also been coming down in various shapes and forms. In order to therefore generate that spread over a declining handle on listed side, investors have to take higher risks on the unlisted side. Again, risks are very important to manage and mitigate. However, these are the areas that offer the new dimension, so as to say a new approach towards investing, and really a new dawn for investors. It's something that is already mainstream, and as we go forward, as the markets mature, they develop greater in terms of width and depth, we will see a much bigger pie being accessed by a much larger pool of investors. Last but not the least, and I'll end with that. A very famous son of Calcutta gave out a very famous poem where mind is without fear. This is the period when investors need to access or need to approach investing with the same mindset of mind not being without fear. It is okay to be cautious. It is okay to be very cognizant of risks, but to be fearful when there is a spike in volatility in the market, or when there is this funding winter in the startup side, or things like that, is the worst disservice that one can do as investors, as money managers, as fiduciaries for others that we might be managing money for. Um, where mind is without fear remains the touchstone for success in investing. Thank you very much, and I wish all the best to the current Calcutta edition of this program.
Thank you so much, Mr. Mukherjee, for setting the tone for today's evening. Well, ladies and gentlemen, up next is our panel discussion themed New Age Asset Class for India. And for the same, I'd like to invite on stage Manisha Gupta, Editor Commodities, CNBC TV 18, to please moderate the session. I would also like to welcome our panelists. Please join me in welcoming all of them. Mukesh Kochar, National Head of Wealth, AUM Capital; Raghav Kanoria, Partner, Anchor Group SA; and Utkarsh Sinha, MD, Pexley Advisors. A round of applause for all our speakers and moderator. Over to you, Manisha.
Thank you so much. It's a real pleasure being in Calcutta. I mean, as was pointed out, we've traveled to various cities, and it has been very exciting meeting people, having, as you saw, regulators, ministers, corporates, thought leaders, and of course, developers, entrepreneurs, even investors coming in and sharing their experiences with us. There are various asset classes when you look at trading within. Equities, of course, has been the oldest there. We've seen commodities trade come in quite strongly. Currencies has been there, and then of course we're talking about digital assets here. It is about debt markets as well. So there's a lot there out open where, and what you perhaps need is, as was mentioned as well, some caution, some discipline, perhaps an SIP as well. So that's exactly what we will be talking right now on what really is it all about. Alternate investments, whether your portfolios are diversified enough, and what do you really need to look forward to. I'll start with you, Utkarsh, and the markets are quite volatile. We've seen Indian elections, the dates were decided today. We've also seen global cues take a lot of precedence. The markets also are looking at equities moving very, very volatile too. In this kind of a scenario, how should a portfolio really look like?
So I think for the bulk of the people in this room and for retail investors in general, the adage which Warren Buffett often talks about, markets are a voting machine in the short term, but a weighing machine in the long term. It makes a lot of sense to stay with your strategy and not be deterred by events such as elections in a very major way. Now, there are opportunities which will get created. If you have a very strong view that the market is either going up or down, you should act on it, but you should never act following the market. You should not sell into a panic market. You should not buy into a euphoric market. So I think that's the main advice or the main guideline that I would have for any retail investor. That said, in the specific environment that we are in today, India has got very strong fundamentals. The macroeconomic outlook is very positive. We are, an island in a global sea of turmoil. And we are a preferred destination for capital, whether it is capital in the public markets or in private markets in India. And therefore, anybody who is participating along with that flow is likely to benefit from that flow. So I would say, stay put.
All right, stay put is the word coming in. Mukesh, this one is to you. So while the markets really are changing a lot, and we've seen new investors come in, new avenues come into the market as well, has that really changed India the way we invest?
What happened in the last few years, like I would just add here that India is in a best ever situation which we had previously, right? Since independence, where we are currently is, I think, is a phenomenal situation where all of us are enjoying that that brilliant space at this point of time in India. So having said that, few years back we were used to depend on FII capital to come in and support our market, and at the same time when they come back to maybe for any global reason, and that has created volatility in Indian market. But as Somnathji rightly said, till at this point of time when 19,000 crore SIP is coming in Indian equity market per month from retail investor. This act with very annual, if I remember correctly, 10 years back, the FII whole inflow would be around 2-3 lakh crore. So this is surpassing that kind of number in retail investor, right? Then there's the EPFO which has been allowed to invest in equities. So that is the number which is coming to around 2 lakh crore per year. And that is continuous to increase month on month. So, and the most importantly, the family offices which used to invest in traditional maybe FDs or bonds or maybe similar kind of real estates, and those investments has been financialized towards this new age investment, particularly this AIF, and we have seen a tremendous amount of change, and this eastern part of India is normally very late in identifying these kind of opportunity, but I would say that I think we are very ahead at this point of time in investing in AIFs and all. So I think it's a great time to be in
Let me just jump in for a quick second. The point that you made about EPFO, I think that's one of the most significant things that has happened. It's comparable to the 401k, movement in the US, and that opened up, private equity and public equity as an asset class, which is accessible to the retail investor. So I think we can expect to see a similar transformation in India as well.
I'll take a step back, and this one is to you, Raghav. I just coming from, as he was pointing out, FDs, Ghar Le Liya was an investment, Jewelry Le Liya was an investment. Now buying gold, it has been financialized in a very different way. Private equity is coming in, AIF is a very strong one now, SIPs, mutual funds. You talk about it and the avenues are open. How has the shift been in Indian markets? How have you seen people actually foray in, get smarter, get mature when it comes to their investments and financialization of their investments?
So I've been in the private markets for 18 years now, across the spectrum. So I started off in a real estate fund, an infrastructure fund, which was very high level, macro sort of private equity stuff. Then moved to early stage investing, started an angel network in East India, and then an accelerator. And now I'm a partner in a Swiss fund, and we look at cross-border technologies between India and Europe in industrial tech, and now looking at a fund for circular economy. So covered quite a lot in the last 18 years. And the one big difference I see from when I started out in 2004, post the real estate FDI policies being opened, that is when the private equity boom started in India. It was very sort of asset heavy investing. People understood it more in the traditional sense of the word. And in the last 7-8 years, what I've seen is now people are getting more asset light and more scalable businesses, so to speak, in the more globalized sense of the word. So I think the investor has matured tremendously in the last 2 decades, so to speak, going for more sort of scalable business model, tech heavy, more deep tech. Now India is seeing a lot of deep tech come in. So, and even a lot of the entrepreneurs who have sold their businesses, they have become investors as well. So the entrepreneur who has turned the investor, he knows the nuances of the businesses, right? So he's a better investor than just a financial investor. So I think that's been a paradigm shift in the Indian market.
I want to come to each one of you with a question. Where were the Indian markets investing 10 years ago? Where are they right now? And how do you look at 10 years from here?
So 10 years ago, I can talk about the unlisted space. I think there was a lot of marketplaces. So there was e-commerce, there was fintech, health tech, all of that took place. And people made money and exited, Flipkart being the biggest. Currently, we are seeing a lot of industrial tech come in. So around energy, logistics, automation, mobility, stuff like that. And in the future, I think what we're going to see, one of the topics for today is crypto, right? I think it's going to get more and more sophisticated, and people are going to invest in intangible companies which you cannot see or feel, but you can sort of have an aura around it. So I think that's where the future is in investing, and India is going to become a more product-based marketplace. I think there are going to be a lot of product companies coming out of India that will be global in nature.
I think I'd largely second that in terms of where we have been. And the trends that we see right now also, I think, are similar. I feel like manufacturing is going to become increasingly significant in India, especially, manufacturing which is higher up on the chain of technology. And so deep tech is going to become relevant, clean tech is going to become relevant, med tech is going to become relevant. We're already seeing green shoots in many parts of India, and I feel like with the right kind of incentives, with the right kind of market structures, we'll see more investors coming in and generating returns in those spaces. And I hope that India is able to shine in that place, because I think we've been through the whole consumption economy, marketplace economy. We've had that run. To be able to do the next round successfully, I think fundamental creation in India needs to happen. We need to go deeper into the tech stack, and I think I'm hoping to see some of that.
Yeah, just to second that, I think manufacturing is a good point. I think manufacturing has been a bit on the back foot in India, technology in manufacturing. So I think that is going to come forward much more. Things like Internet of Things, predictive maintenance, things like that.
So I just add to that, that manufacturing is a bigger theme for sure for next 10 years. If you see that till 2007-8, we have done a lot of capex. All the corporates and government capex has happened like anything till 2007. But post that, I think till 2020-21, no capex has happened. Major capex, I would say. Some small part of capex has always happened here and there, but not a kind of sizable capex has not happened in those period of time. It has again started in 2021 and is carried over like anything. The most part of our budgetary allocation is towards this manufacturing sector only. We have come with PLI for sure, which is again helping this manufacturing industries for sure. So this definitely is going to be one of the sunshine sector for next 10 years. Apart from that, I think Indian market is evolving. As the world is evolving, Indian market is also evolving, and new sector is going to add in next 10 years for sure. Like EV is evolving like anything, the hydro gas and this. We have to be self-dependent in terms of we are the net importer country at this point of time, and we are importing a lot of crude, and that is for sure impacting our economy. So that is the major part where India is looking to reduce that dependency on this import bill, and they are going to increase this gas production and hydro energy and all. So energy is going to be another, I think, big investment going forward.
Yes, so manufacturing, renewables, and of course, the future of tech is something that we're looking at, digital assets being one part of it. I'm enjoying this, asking one question and you getting you all to add to that. So my next question really is about how are we segregating investors as of now? Do you think there's a category like the old investors and the new investors coming into this market? I mean, of course, people will continue to buy traditional investments as well, but PE, digital assets, AIFs, do you see a new crop of that?
Yeah, I think when you're talking about the kind of investors, I think family offices have been structured in the last few years. And a lot of the younger generation is becoming part of that decision-making process. So when I speak to investors who are from traditional business houses as well, and Calcutta has a lot of traditional business houses, is that the younger generation which has studied abroad, worked abroad, right, they are following the global sort of culture that is prevalent. And it's becoming much more professional in terms of decision-making on investments. So earlier it was more real estate, gold, fixed deposit, more investment into their own business, things like that, right? But now family offices have been created by traditional families, and the youngsters are investing in alternate asset classes like venture capital funds or even DeFi and, crypto, other assets which are prevalent as of today. So I think that is one main difference that I see in the investment culture here in Calcutta.
I would say that, when it comes to people who hold wealth, the culture of diversification has started. Earlier, there was a whole idea of, holding your entire eggs in one basket, holding, firm control of the family business. Families have become a lot more open towards, raising equity, diversifying out of their own holding in their own company, and then having, as a result, that pool of capital to invest, and then applying, classic CAPM to be able to get a diversified portfolio out of that. When it comes to how that diversified portfolio is being spent, I think the exposure to AIFs today is still low. The exposure into AIFs should go up, especially if you've got patient capital. You do not have an immediate need for liquidity, and you're parking a certain percentage of your portfolio into alternates. AIFs are a great instrument for you. For the retail investor, I would still maintain, and I'll also say that, I'm the son of a regulator, so I'm very conservative, a former regulator. So for the retail investor, mutual funds are still one of the best things that you can put your money in. I used to work at Bridgewater, which is a large hedge fund, and we had a weekend where we just had time, and we did a study of who the best generators of returns are. And over a 50-year period in the US, the best generators of returns were managers who had either died or who had not done anything, right? And who had invested in the index fund. So you cannot go wrong with that strategy. If you have a good index fund that you put your money into, you are diversified, just hold on tight, you'll do well. Don't try and, follow a trend. Don't try and jump onto a noise. More often than not, you'll be late to the party and you'll be the one holding the cushion when the music stops.
So there is a concept of asset allocation. So we have seen, maybe it's a old generation or new generation, this concept has been understood well by the investor at this point of time. And by and large, except few, by and large, I think the acceptability of this new product has been very, very good. And as he said, the allocation of amount is not that large. It's a percentage of overall allocation. Maybe somebody is putting 10%, somebody is 20, some 25. It is the number game basically. Somebody is putting some number and so it's aggressive and conservative kind of approach which is having. But it's very sure that everybody is accepting this asset class, which is the new generation asset class. And we believe that going forward in next 10 years, I think this is going to be one of the biggest asset class. And it will be comparable to mutual fund kind of thing, which is around 50 lakh crore of industries. And we are at less than 10 lakh crore industry in AIF. So I believe that going forward, it has the potential to go towards that size.
If I may just add a quick point to that, one of the biggest mistakes that investors make, family offices, is that it's story-driven investing. Everybody. When I came back to India in 2017, there were a few Ola millionaires and a few Oyo millionaires. And everybody wanted to invest in one company because they believe that's going to be the next Oyo or the next Ola. You really need to be able to have a structured, diversified approach to investing, which is why AIFs end up being one of the best ways to do it. You will most likely not be the one who is just spotting that next, uncut gem. So it's better that, you have an allocation and you treat it with a disciplined approach rather than thinking that you've just discovered something.
Well, absolutely. And it doesn't harm to, of course, have long-term investments and some bit of instant gratitude as well. I think we all thrive on that in some sense. Okay. There was a report which suggests that AIFs and in last 7 years have grown up 10-fold. So there is like trillions of dollars, $7 trillion as the last count being held into that. What do you think has brought in such huge surge?
So I think everybody wants diversification in their portfolio. So like I said, that from the generations that have been moving on, people have worked abroad and got exposure abroad and wanted to bring that sort of investment knowledge and theory into the Indian ecosystem as well when it comes to investing. Also, people want better returns, right? So when you look at fixed income, there are different products in AIF like REITs, InvITs, etc., where you can get better returns from structured products. So it's not only about venture capital, but also structured product, AIFs, category 2, then you have category 3 like, hedge funds and PIPE, etc. in public portfolio companies. And then you have, of course, social impact venture funds coming now and also venture capital and angel funds, which are the higher risk quotient. So across the categories, you have different kind of risk profile and returns that one can generate. And depending on one's risk appetite, you can take part in those kind of portfolios. So I think that is one of the main reasons. One is the portfolio diversification, the global exposure, and the higher returns that one needs. But when we started also, we said, okay, people are saying how much should we invest, right, in these risk assets. So we never say put 50% of your money or 40%. It should not be more than 15 to 20%, because that's the kind of risk that one takes in your overall portfolio.
Utkarsh, while we've spoken about various categories, but we do understand that in the recent run that we've seen in various asset classes, it has been an India story. It has been the domestic pool. Do you see Indians wake up, start putting in money? As Somnathji was also saying, out of 140, even if you see 10% of that money coming in, do you see that finally actually coming in?
Do I see Indians investing abroad?
So the longest time we would watch out the FII's data, on whether they're buying or selling. But lately, it's all been about domestic investors.
Oh, yes, absolutely. I think domestic investors are very, very relevant in the picture, and their relevance is growing. And when I say domestic investor, I'm talking about domestic institutional investors as well. If you talk about the AIF space, pretty much all of it has been seeded by, a couple of, key, government initiatives, whether it's SIDBI Fund of Fund or NSIC's SRI fund. So Indian institutions are very relevant in the picture. Indian family offices have also really, ponied up and are contributing. I mean,
and look at the kind of demat accounts that are opening every month, even Calcutta, Gujarat for that matter.
Absolutely, absolutely. In fact, Calcutta is a very, very critical part of the financial ecosystem. When the NBFC boom happened, 30% of NBFCs are registered in Calcutta. And I'm not saying that's all good. I mean, there's negativity to that as well. But I mean, Calcutta latches on to, innovation very quickly. I don't think the AIF innovation has hit Calcutta. That wave has not, hit here yet. But I think, there's a lot of opportunity to really make good money in that. But again, with a lot of caution. Because one of the challenges about the AIF space in India, which I don't like, is that the 220 model ends up giving you enough money that you can be happy without performing. So, 2% of, 1,000 crore fund is 20 crores. That's enough revenue for you to have a very comfy lifestyle and not really strive for the best. 2% of, 100 million fund in San Francisco is pittance, right? You really, you're very hungry to get that, carry. So your selection of your manager for your money is very important. And I think, you need hand-holding for that and you should seek advice.
So while we're talking about bigger cities and Calcutta and etc., Mukesh, would you say tier 2, tier 3 cities also are now getting smarter when it comes to investing, especially in AIFs?
Yeah, very much. I would just like to add here that COVID has changed the things a lot. Post-COVID, people's thinking has changed and they've started to create family offices and diverted in the sense in terms of dividend or salary or whatever to their personal accounts and created family offices. So post-COVID, the number of family offices increased like anything, even in the tier 2, tier 3 cities. That has particularly helped because in corporate, you cannot invest in any asset class which is of 10 year, 5 year, or maybe even longer and without any liquidity, right? So the family office has a higher risk appetite and they can wait longer for their investment to mature. So ultimately what happens that this money is pouring into this AIF's world or maybe alternate assets overall. By and large, this part I think has played, and at the same time, COVID has everybody is having smartphone at this point of time. This is because of COVID, and that has changed the technology at all, like anything, and that has been instrumental in success of many startups, many new age companies. So I think by and large that is one. Secondly, he's rightly said that institutions are putting money like anything. Many banks are putting money, insurance companies are putting money. This SIDBI and names like such are putting money. So the capital is huge, which is chasing this space for sure.
On tier 2, I have one point. Basically, I've traveled a lot with the CII Innovation Task Force in tier 2, tier 3 and tier 4 towns also in East India. And there's a lot of cash generation in these places and the avenues to invest are less. So I think when VC funds go to these towns, the reception to invest in these funds is very high. Like I know some funds based out of Mumbai and some angel networks also raise a lot of money from these towns. So I think, yes, it's a very good avenue as a source of LP money to cater to funds, basically.
Wow, there's a lot of money, there's a lot of wealth creation, and even more in tier 2, tier 3, even tier 4, as you said. All right. So when we talk about AIFs, if I'm making a portfolio, what are the various categories I should be choosing from? How would you, what would you advise?
So I think basically there are 3 categories of AIFs. Category 1 is more on the innovation and entrepreneurship side. So you'll have angel funds, VC funds, social impact funds. So more on the early stage investing. Category 2 is more real estate funds, private equity funds, etc. So higher up on the investment ladder. And last is category 3, which is more which is basically hedge funds and public investment in private funds. So depending on your corpus, so basically if you have a large corpus, you can go in category 2 and 3 as well. And if you have a little bit of smaller corpus, you go in category 1 mostly. But that's not like something cast in stone. You can easily flip between the categories. But chances of returns getting higher is easier in category 1. It's more boom and bust. I mean, you could have a very big success story and a lot of buzz. In the second category, it becomes a little more rational, and the third is even more rational. So that's how you sort of look at it.
How are you invested?
No, I've been in category 1 only, so I've not moved to 2 and 3 yet.
All right.
I mean, there's not much to add. I think he's covered it fairly comprehensively. The only small addition is Cat 1 usually is able to take smaller checks, because the Cat 1 funds are typically smaller. Cat 2 funds will not entertain checks which are less than, say, 2-3 crores. For most of them, it doesn't. But again, it's a function of the size of the fund. So it depends a lot on your appetite and your investable capital. What's more important for you is how well diversified are you. You should go heavy on someone that you have a lot of belief in, have a lot of who have demonstrated track record. If you're taking bets on new entities who have not proven themselves in this particular asset class, your exposure to them should be limited, and it should be a limited portion of your own portfolio. So I think that's more relevant.
So if I'm not wrong, around 80% of the AIF corpus is from category 2 only. So in that sense, that is the most popular category for sure. The simple reason I would say for that category to build up so large is there are multiple options within that category, like maybe private equity is there, venture debt is there, there's performing credit is there, the structured credit is there, there's distress credit is there, real estate funds are there. So a lot of things are there across within this category too. First. Then secondly, the risk reward ratio is comparatively better. Because in private equity space, in this category 2, most of the funds are from growth stage. They're investing growth stage. So at growth stage, the unit economics has been fixed. The sales is there, at least 50, 80, 100 crore, whatever it is, the sales is there. So the company has been identified and the scale is required only. So the funding is done for the scale only. So that is what. So risk.
Actually, surprisingly, that's the second point is not correct, because surprisingly, Cat 1 has given better returns.
Yeah, that is true.
I think at the individual level, the risk is there.
Risk reward.
Right.
Yeah, I'm just thinking
guys, just tell me, where do I invest?
I would say it should be a mix of everything.
That doesn't help. I mean.
It should be a mix of everything, but if you're thinking about the AIF space, it depends on your check sizes. I would say for most smaller retail investors, Cat 1 is the safer bet, although I work mostly with Cat 2s. So I would say that most folks should not get into Cat 2s unless they've got, they're willing to write 20 checks of 2 crores each. Right?
I think it's totally depend on risk appetite of one's own investment, right? That's the one. And the most important thing which has changed recently is the tax angle of debt mutual funds. Government have changed the taxation, the indexation benefit has been removed from debt mutual funds. And that fund is again coming to performing credit, which is category 2. So that is huge market, and that has gained, I think, a lot of traction recently. So that is also one important point.
So the reason why I am involved in Cat 1 is because I am more interested in the entrepreneurship side of it. So a lot of investors who invest in Cat 1 want access to those companies so that they can also co-invest. They can have some sort of arrangement with those Cat 1 companies also. Cat 2 is a little bit more detached because the companies are much bigger. So it really depends on you as an investor also what kind of knowledge you want. It's not only about financial returns, but also about other aspects of the portfolio company that you can engage with. That is more interesting. So that's what works for me, basically.
Yeah, in many ways, the category of the fund is a lower order bit. The strategy of the fund and how well it aligns with you and what your objectives are is more important. The fund will find the best strategy for its particular mode of execution.
AIF's clearly buzzing, and Kolkatta is slightly behind, as our panel tells us. So this is your masterclass when it comes to AIFs in that sense. I also want to talk about private equity, guys, in slightly more detail. While of course the listed companies is something that is all out there and open. So we'd also started talking to guys which are family businesses and not listed and deep pockets, and maybe or maybe not will list going forward in future. How do you look at this scenario? Because yes, everybody wants a long-term capital. There's more entrepreneurship. There is wealth creation that is happening. What is the future here?
You're talking about pre-IPO. Yeah, so I think that's closer to the liquidity event. So basically, investors who have liquidity and want to get quick returns, there the pre-IPO funds are doing well. So because in a AIF Cat 1, the liquidity event will be after 5-7 years. because the fund structure is such that it is 7 years +1 or 5 +1 So as an investor, you have to wait for a long time to get the returns. But in these pre-IPO funds, you could get a return in, let's say, 2 years or 3 years. So people who are looking for quicker returns, it's a good avenue to invest as a financial instrument, basically.
Again, I think there are two aspects to it. One is exactly what you were talking about in terms of, the returns and the access to returns quicker relatively. One of the most fundamental shifts that has happened is, with a lot of the second generation entrepreneurs, who are taking over, their fathers or their mothers' businesses, they're a lot more open to raising equity. So there was traditionally a mindset that, this is the family gold, you can't touch it. Selling equity was almost seen as a shameful event. You got a partner in your business when you were not doing well. If you're doing well, you just, went to the bank, you had a banking relationship with them, your bank loan goes sour, that's when you get a partner and you give equity to them. So that mindset has shifted, and therefore there's an openness to raising equity. And it makes a lot of sense because you've got two arms. One is your equity arm, one is your, debt arm in your capital structure. You're going into battle with your equity arm tied behind your back. So the fact that, families are waking up to the reality of equity as a funding option is very good. The challenge is that, we don't have as many funds in that space. So the reason the VC industry has done so well in India is because there's enough number of funds at each stage. Whether it's pre-IPO or all the way towards the end of pre-IPO or very early when it's pre-seed stage. There are a number of funds who are just, passing the baton on in that journey. When it comes to non-tech private equity, we have got a few funds in the early stage, but maybe there are 10. And then the gap for a company which is, 200 crores to 2,000 crores, where the Blackstones and the Carlyles of the world, or 1,000 crore where some of the pre-IPO folks get interested, is very large. So there's still a gap. Those beacons are not there along the way to guide the companies to that growth. So you have to fund a lot of your growth through debt and through traditional means before you break into that kind of stratosphere where, the late stage folks are interested in you. That's a bit of a challenge.
So, the pre-IPO companies in which these funds invest, they have done a long-term journey, and the investor are already at the stage of maturing their investments. So the Carlyle or Sequoia or these kinds of people are wanting an exit, and this is for them only. So I would say the valuation point is very, very difficult at this point of time. We know the Paytm IPO at 2,100 and the pricing. So the pre-IPO, I think, is the stage where the pricing may not be favorable to the investor, but we are giving to the managing partner of who are reputation in the market, and they know which company to take or which company to not. So in that sense, I think pre-IPO is a good investment option who are looking for 3 to 5 year kind of investment horizon and not longer than that, because everybody is not willing to wait for 10 years, right? So that is one part. So it can be an entry point for any investor, but I would again said that both stage category 2 is, I think, best suitable for the investor.
I think that's a very excellent point, the point he just made about Paytm, because I think, and the role of bankers like myself is very critical. Are you willing to leave a little money on the table? Are you going to go for that post-IPO pop and post-IPO performance, or are you just trying to get everything in one go? And I think if you are an irresponsible banker and you just try to maximize at that point, you are the one who's got more information. You are the one who's got, you are the one who's the seller. The buyer should not leave the transaction feeling that they've been taken for a ride. Thankfully, the Indian IPO market is still, ebullient. There's a lot of, weight on the shoulders of the bankers to keep it that way.
All right. Since we are talking about, and this is the final round of questions, we've just got 3 to 4 minutes now. We're talking about technology here. We're talking about Web3 and blockchain. And, a lot of industry people that I meet say that, we wish, and it's not just plain about crypto, but they're like, we wish that, house sales were on blockchain, and the kind of grain movement is on blockchain. The diamonds we wish were on blockchain. A lot of metal companies already have started doing that as well. How do you see this technology going forward as a investment avenue?
I think blockchain is going to be all pervading, right? Because it covers almost every industry, whether it's manufacturing, healthcare, of course, financial industry. So blockchain basically, or Web3, let's say, is going to secure a lot of transactions in future. It is going to give access to a lot of people to control their assets, which was, earlier. And it has contrasting sides, right? You can control your assets and you cannot access it, right? Because it's all distributed. So I think Web3, blockchain, And cryptos we've seen very volatile in the past. There's been a lot of regulation around it. So I think this story is going to play out in the next 3 to 5 years in major economies in the world. And India, I think the regulator has been a bit cagey about it, given the volatility around it. But I think as an asset class, if you want to be an investor, it's a good area to invest in future.
Well, we've seen all regulators quite cagey in recent past.
So I did my undergrad at MIT, and this is back in 2006-7 when blockchain was just being created. So, I was there at the inception, and it's a technologically marvelous thing. But it still remains a solution in search of a problem today. And the challenge is that, the two things that it's supposed to do, whether it's as a store of value or a facilitator of transaction, in both of them, it's not there yet. Store of value because it's, it's unpredictable. Facilitation of transaction because each transaction is expensive. The challenge is it takes scale for it to be able to get these right. So it's a catch-22. It's a chicken and egg, where the scale gets there first or the problem is fixed first. I don't know what the pathway is forward, frankly.
So I think it's an evolving technology, and everybody wants to use it for the best of their interests. And for sure, technology is a thing which keep on changing for sure for every 5 year. So we don't know what happens after 5 years to the blockchain industry. But at this point of time, I think it's very exciting, and we can see a very good future of this. A lot of private equity funds are running funds based on technology only. They are investing in tech companies only. I think very few companies are available in this particular aspect of the business. But as some companies are investing overseas also, I think this opportunity has to be taken seriously for sure.
I was actually talking to one of the Coindcx senior management, and they feel that it's going to be the best asset class in future. So we don't know how it's going to play out.
So it has become 7th largest asset class, I think, the cryptocurrency at this point of time. It has surpassed silver also.
Yes, it surpassed silver and it surpassed Swiss franc and various other currencies. So yes, it's on a high there. So well, absolutely, various exciting asset classes there. Some that are traditional, some that are really working in right now. And we've of course spoken about the asset classes of the future as well. With that, we can take a couple of questions before we wind this down. If there's anything that you would want to ask our panelists, we're open to this. We have that coming in the next panel. Anything? We have absolute experts sitting here. You have, do you all invest? Yes. Yes, please. Can we pass on a mic to him?
Let me play the devil's advocate. As Sir said, that Warren Buffett said that, you quoted Warren Buffett. Let me quote Warren Buffett again. He also said that, diversification is a protection against ignorance. What do you think about that?
Could you repeat the first part of your question, sorry?
As I said, as you also, let me play the devil's advocate. You said, you all three are emphasizing on diversification. So my question is, Warren Buffett also said diversification is a protection against ignorance. Just imagine, even
you are absolutely right.
Just a second, sir.
Yeah.
If Dhirubhai Ambani had also thought the way you had thought, and where Reliance Industry would have been.
You are absolutely right. Diversification is a hedge against ignorance. If you're willing to devote your life to investing, then you obviously don't need to diversify. But for most of the people, investing is going to be a passive decision that you're making. Unless you're willing to be very active and monitor, and there are people who do that very well. I have friends who are, who are devoting a significant amount of their time on managing a very active portfolio. For them, diversification is not important. But for for 90% of the people in this room who have got a certain allocation that they're going to make, diversification is definitely a hedge against, adverse performance, and there are values to diversification. But if you're going to be active, diversification is not something as critical for you. You might go, you might study one particular thing very well, have a very strong view on that, make a bet on that, and have, outstanding returns. In returns, if you're going to be devoted to it, you probably will beat most of the people who are diversified. The diversified folks might get 14%. You might get 28%. But you'll also have to devote a lot more time and energy to be able to get that result.
Just
also on the lighter side, I wish we
over
were
diversification
all,
and under diversification, both are hazardous basically. Sometimes people ends with over diversification, and sometimes go very aggressive with very few options selected. So I think both are very problematic. As he rightly said, if you are actively as an investor and you understand the topic very well and you are giving your full time to this industry, you can be very selective in your investment. Otherwise, you must diversify your portfolio. That is the asset allocation concept is very important.
Your research can't be that my neighbor told me or a WhatsApp group. So if that's not the thing, then you should, you don't need to diversify. You were saying
also,
something.
on a lighter note, I think I wish we were all Dhirubhai Ambani, but the reality is we are not. So I think as normal trend human beings, we need to diversify to get access to different asset classes and diversify our risk profile.
And also, I think investing and entrepreneurship are two different things. If you're an entrepreneur, you're doing a business, you better do one business very well because it takes 200% of your energy and time. But if you're investing, you do not need to have that same kind of devotion to one particular, investment that you have made. So.
I have a follow-up question on that. How many places should you really be diversified into? Because as you rightly said, you can't know everything too well.
I think, again, it's a very individual. I think there are people who have solved that problem, wealth advisors, and you should have a good wealth advisor. But at a very high level, it should be diversification of asset types and diversification of, entities within that asset. So if you're doing, I think for most people, 70 to 80% of equity works. And when I say equity, I mean public equity. Holding 20% of debt makes a lot of sense if, you just want that, steady thing. And in many cases, debt and equity behave differently, especially in volatile times. So they offset each other. And then having 10% to play with. And that play with could be, AIFs. It could be crypto if you're so inclined. There is money to be made in that. It's speculative at this point, but there still is some to be made. And it might be some other, it might be gold, it might be anything that you like. But it depends a lot on what your needs are. Are you planning for your child to go to college in 15 years or in 2 years? That changes how you're going to approach that decision. Are you done with your kids and you're just, enjoying retirement? Are you planning to leave a, nest egg for your daughter? That's a different, way that you'll approach that question. So I think it's very individual.
Absolutely. Very agree with that. Yes. We will pass on the mic to you.
Sure. Sorry. Hi, good evening. Can we have some inputs on REITs as an asset class? Thank you.
Take that? REITs.
Not much has been talked about it this evening.
So it's part of category 2, basically, real estate investment trusts. So basically, from what I understand from a REIT is that a lot of the investors can put in small units into the REIT, and the REIT has to distribute most of the money back to the investors. But I think if you want to throw some more light on this.
The cash flow which REIT receives, maybe rental income or something like that, 90% of that has to be distributed to the investor as per the SEBI mandate. Generally, there are 4 REITs listed on the Indian Stock Exchange, and there are many private REITs are there which are traded privately. Most of them are paying quarterly cash flow to the investors. It's a kind of quasi-debt instrument which give you a kind of regular cash flow, but at the same time they are listed on the stock exchange and the price are getting fluctuated every day. May not be at the pace of equity, but maybe in between a equity and a debt kind of fluctuation you can see every day. So that is one. The challenge which most of the REITs and InvITs are facing at this point of time is they are not been able to add new assets into their portfolio. So if these are the assets which are forever, right? It's not going to mature any day, right? So they have to acquire assets continuously and leverage their positions continuously to make it a continuous kind of investments and cash flow. If REITs are not been able to add assets, then the price used to fall, and there are other factors like interest rate and all which also reflect their prices on the exchange basically. So it's kind of quasi-debt investment.
REITs is basically an avenue for the retail investor to participate in real estate assets, because as only institutional investors can participate in land buying and stuff, but this is an opportunity for retail investors to participate.
All right, with that, this panel comes to an end. Thank you so much, gentlemen, for joining us, and that really was an enlightening conversation, and we hope that you've gained a lot of gems from that. Thank you for your questions and patient listening.
Thank you so much, everyone, for such an informative and engaging conversation. Thank you. Well, ladies and gentlemen, Moving on, we now have a keynote address by the Managing Director of Kotak Asset Management Company, Mr. Nilesh Shah, who will be sharing his insights on how to build wealth with new age investment opportunities. Unfortunately, due to prior commitments, Mr. Shah is unable to attend today's event physically. However, he will be joining us virtually. A round of applause for him, please.
Namaste, Kolkatta. It is my pleasure to be part of Namaste Web3 event launched by Forbes along with Coindcx on wealth and new age investment. Unfortunately, I am not able to be amongst you in person, so please consider my virtual presence. And hopefully in near future, we will be able to catch up. Today, India is doing extremely well on an economic front. Are Indians doing as well in participating in this growth story? When we see savings, Indians are doing great job. 30-35% savings to GDP ratio is good. But when it comes to investment, we are not as good. We can be better. What should we be doing? Today, we find Indians going and investing money in currency notes. In last 3 years, household financials flow towards currency note was about 9 lakh crore, whereas in mutual fund it was less than 4 lakh crore. Why are people keeping money in currency notes when it is a depreciating asset? People go and trade in FNO. Though SEBI studies suggest that 89% of people trading in FNO end up on the losing side. People go and invest in Ponzi schemes and then they lose their capital. Why are Indians not as good investor as they are saver? I think there are a couple of things which we need to take care. One, in our culture, we have been told, don't run after money. पैसा जिंदगी में सब कुछ नहीं है. I have always liked what Warren Buffett mentioned. Money is not everything in life. Money is not important. But make sure that you have made enough money before you make such statement. In our traditions, in our culture, we give equal respect to Saraswati Mata, goddess of knowledge, and Lakshmi Mata, goddess of wealth. Number 2, investment is all about common sense. But that common sense is commonly not applied because we, all human beings, are driven by emotions. We lose our rationality when we lose our equilibrium. We need to be equidistant between greed and fear. In March 2020 COVID era, we were driven by fears, and today we might be driven by greed. We must balance between greed and fear. Third, little drops of water make an ocean. Same way, regular investment will build your retirement kitty. You should not put all eggs in one basket. Same way, a disciplined asset allocation between debt, equity, gold, real estate, alternate assets will build your investment portfolio, which will deliver better return than inflation. And finally, jaldi ka kaam shaitan ka. There is no shortcut to success. You need to be a long-term investor. Today, we are indeed lucky to be born in India. It's an oasis in desert. It's a fastest growing major economy. And in our Amrit Kal, we are marching towards becoming a developed nation. My father is not alive today. But if he was alive, I would have gone to him and asked, Papa, you know, when multinational company shares were available at such a low price, when IPOs were happening at such a low price, if you had invested in them, probably there was no need for me to work. And my father would have replied, Beta, your point is right. But there was no media from Economic Times and Business Standards and Financial Express to CNBC to ET Now, which told us how to invest. There were no magazines like Forbes, which hosted this kind of seminar. There were no people like you who were talking to us about need of investment. There were no mutual fund distributors who could have told me how to invest. And hence I missed the bus. I will probably forgive my father saying that, don't worry, Papa, I will work hard. But imagine 15, 20 years down the line, you are sitting and your kids come to you. Mom, Dad, when India was marching towards developed nation in its Amrit Kal, why didn't you invest? Why didn't you participate? What excuse you can give? I was trading in FNO. I was investing in Ponzi. I was good saver but not an investor. Trust me, it will be very difficult to answer them. It is still not late to participate in India's growth story through discipline, regular and long-term investment. Undoubtedly, equity markets have run up. They have delivered fantastic return since March 20 COVID lows. There will be ups and downs. There will be volatility. But yet, a regular and a long-term investment in equity will deliver above inflation return over a period of time. All you need is to maintain disciplined asset allocation. Today, equity markets are fairly valued. They are little expensive on small cap and micro cap side. Try to invest on a regular basis in large cap and larger mid caps. If you can't pick up stocks directly, you can always look at mutual funds. Consult your mutual fund distributor as to which products will be meeting your requirement. On fixed income, we believe interest rate cuts will happen. There will be buying from debt foreign portfolio investors in our market as we become part of bond index. This is probably the time to accumulate duration. Rates have run up like equity market, but we believe with some volatility, there is room for rates to go further down. This is time to pick up longest maturity possible. On gold, we believe central banks buying of gold will support prices. If US interest rates falls as expected towards end of 2024, that should also support gold prices, and gold should do well in the years to come. Gold also has run up, no doubt about it. But if you take a longer term view, gold should do well from here onwards. When buying gold in India, do remember there is 18% tax incidence, and those tax incidents could get reduced over a period of time. If that happens, there will be correction in rupee gold prices to that extent. Subject to 18% tax incidence, we think gold also should be part of your portfolio. Alternative investment are also a great opportunity. There was a time when Indian talent was going abroad for better opportunities. That's how Satya Nadella went out of India and eventually ended up running Microsoft. Today, Indian talents are staying back, but many talent does not have capital. In the past, your parents' capital was your startup funding. Today, there is a vibrant private equity venture capital system which gives capital for good ideas. Clearly, when you combine talent and capital, it can produce wonderful results. Undoubtedly, startup investment is higher risk, but that's why it provides higher return. Be diversified into private equity venture capital. You never know which one will work. But if you invest in a good talent and back it up with your capital, then startup investing could create wonders for investors. Let alternate investments also be part of your portfolio, as it will give access to certain kind of investing or instruments which are not available, let's say, in listed market. Overall, regular investment, long-term investment, and disciplined asset allocation will be something which will work in your favor over a period of time in securing your financial freedom. Many a times I have seen people know what they have to do. It's just they are not able to do what they should be doing. I'll just give you one incidence which hopefully will give you enough tool to manage your emotions. In Mahabharata, when the war was about to begin, Bhagwan Krishna went to Duryodhan requesting him to give 5 villages to Pandavas to avoid the war, to avoid the bloodshed. Duryodhan refuses that. Bhagwan Krishna tries various arguments to convince Duryodhan that what he is doing is wrong and his dharma is not what he is doing. Duryodhan replies to Bhagwan Krishna, Janami dharmam nachme pravrutti, janami adharmam nachme nivrutti. Oh Bhagwan Krishna, don't tell me what is dharma. I know the dharma, but I can't follow it. And don't tell me what is adharma. I exactly know what I'm doing is wrong, but I'm not able to stay away from it. In all of us, a Duryodhan stays. We have been told not to eat junk food, and yet we can't stay away from it. We have been told not to drink colas, yet we can't stay away from it. Same way it is in financial field. We know regular investment, long-term investment, disciplined investment is key to securing financial freedom. But that Duryodhan pushes us to go to Ponzi's, pushes us to go to trading, pushes us to experiment, pushes us to become greedy when we should be fearful, and fearful when we should be greedy. I hope all of you are aware about your Duryodhan and are able to control it. Follow the path of regular investment, disciplined investment, and long-term investment, and secure your financial freedom. Hopefully next time we will be meeting in person. Wish you all the very best. Happy investing.
Thank you so much, Mr. Shah. That was truly an enlightening address. Well, ladies and gentlemen, before we move on to our next session, here is the QR code on the screen, which you can scan to join the Namaste web Telegram channel. And for further information, do visit the Coindcx stall outside. And with that, we are now moving on to our fireside chat session, which is titled Crypto as a New Asset Class Mapping the Future. Well, here's an interesting fact. You may be aware that India has the largest number of crypto investors globally, but do you know that Kolkatta ranks as the 3rd largest city in terms of crypto investors in India, following Delhi and Mumbai? Well, this highlights the significant presence and interest in crypto trading of this city. And without further ado, to moderate this session, may I please invite back on stage Manisha Gupta. A round of applause for her, please. And her esteemed panelists, Siddharth Gupta, Head of Business and Strategic Alliances, Coindcx, and Mukesh Jindal, CEO, Alpha Capital. Over to you,
Thank you. Well, there are gems and gems coming out of everybody who we've had on this stage until now. Well, absolutely. Discipline and ensuring long-term investments is the key. And of course, looking for more diversifications, looking at new age asset classes as well. And that's exactly what we will be talking about right now. First of all, we've 2021, 22 weren't such great years when it came to crypto. We saw all-time highs and then we saw a very sharp decline as well. Crypto winter, as it is called, perhaps is gotten over with the kind of run-up that we saw in last 6 or 8 months. How are you looking at this as an asset class? As said, India is the third largest investor here. We have seen a lot of registrations. People perhaps are waiting for a right time to get into it. How do you look at the scenario right now?
Manisha, if you ask me, I think with every asset class, there is a maturity period, right? That happened with equities as well. I feel today crypto is at the same juncture which equities were maybe 30, 35 years ago. The kind of volatility, the kind of, the bullish, bearish kind of signals that we see in crypto is something that we have seen in equity in the past as well. And any asset class which is new takes time to mature, takes time for adoption, and for the investor penetration to understand the real technology behind it. With crypto, we expect the same. If you look at certain data points, the average age of crypto investors in India, what it was in 2021 versus what it is now, is increasing with time, which shows that a lot of...
What was it then? What is it now?
Sure. In 2021, it was about 24, 25 years of age, right? And now that's gone to 28, 29, right? So of course, still a lot of young blood coming into it, but it shows that it's slightly maturing as an asset class. And this is definitely gonna increase with time, right? And that's what we believe. Regulations are on the way. We already have taxation in the crypto space that's delivered by the government. We have the Financial Intelligence Unit, which regulates and licenses all crypto platforms in India. We have the Money Laundering Act, right, which prohibits any evasion of taxation or any evasion of foreign exchange from the country moving out. So things are moving in the right direction. Things take time. And that's what we believe, that with the right set of time, this is an asset class to stay for sure. The market cap says that. And we have great times to come about.
Well, yes, market cap is another story, by the way. Higher than silver market cap, higher than
Correct.
Swiss franc.
Yeah.
And fast getting to various other corporates.
Absolutely,
and country GDPs as well. I mean, the data is enormous.
Yes, I think it's the 7th biggest market cap by now. More than Bitcoin itself alone is $1.4 trillion. The entire crypto market cap is close to around $2.3, $2.4 trillion. So yeah, really picking up pace.
Sure. If you held on to your crypto that you bought perhaps 2 or 3 years ago, you would be sitting on huge monies right now. But that is exactly my question. As Nilesha was trying to tell us, that even as investment has been around for years, it still is about discipline, SIPs, long-term, having a visionary stand on what you are putting in as your money. When it comes to crypto, how would you add up all of this?
Manisha, in fact, what Nilesh bhai said, made a lot of sense. And before I answer this question, I want to check in audience, how many of you are crypto investors? Kolkatta is the third largest. And, let's see how many of you have not invested in crypto till now.
A major chunk. That's
so this is a majority of chunk. And, for the benefit of everyone, I want to give them some information that on January 2023, crypto, the Bitcoin, let's say, everyone understands Bitcoin. It was trading at 16,500. Today we are trading at 70,000. It has given a return of 325% in last 15 months. It's the highest and amazing. Now, a lot of you will be saying that, it's a rally, it's a bubble, but I'll give you one more interesting insight. That, we have data since 2011. In the last 14 years, Bitcoin has given an annualized return. Can someone guess what would be the return? Per annum return? 140. So, the gentleman over there is right. It is given per annum return of 155%. And what is also more interesting, that out of these 14 years, 11 years, Bitcoin has given highest return. So it's not that the few years Bitcoin has not, given big returns. 11 consistent years. And what is also important, 2024 has been very promising. I'm sure the people who are not investing, one of the key reasons is they think it's a Ponzi scheme, it's a scam. But, let's be clear that Bitcoin and crypto has been there for the last 15 years. Any Ponzi scheme or scam has not lasted for so long. And January this year, the US has approved the ETF, the exchange traded fund of Bitcoin. So technically, it has now become legitimate. So it's big, and yeah, what Nilesh Bhai said, the principles of asset allocation, long term, it's all valid over here.
So, again, when you look at the crypto prices itself, I don't want to use all of those words, but as an asset class, as external factors impact various other asset class, so is the case with cryptos.
Yeah, well, that's actually true, right? You'll be surprised that, if you look at a lot of macroeconomic events, we have a lot of underlying volatility that also gets clubbed into crypto. We look at US employment data, we look at CPI data. Fundamentally, of course, a lot of it is still globally driven and still centrally based out of what's happening in the United States and not into more of the regional geographies. But it's very clear that, a lot of these fundamental aspects are starting to draw into crypto. People, when I talk to them about crypto, they tell me, if I am buying a Reliance share, I know what I'm buying into, right? I know there is a company, they do this is their EBITDA, this is their margin. But surprisingly, that's also true for a lot of crypto assets. Yes, there are two sides to a coin. There are a lot of other coins which are just for the sake of it. But there are a lot of fundamental companies being built on the blockchain, which do have all of these fundamental factors involved as well. They have exactly quarterly results like every other equity industry has. They have a market cap, they have a price to book value, they have an EBITDA percentage. So they have all of these fundamentals which you could base your results on. So fundamentally, whatever actually applies in other asset classes actually does apply to crypto as well.
Well, yes. So when you talk about crypto and, the way the markets have moved, and when you talk about discipline, and you said the way the prices went to all-time highs, went to real lows, and we've made all-time highs yet again into the markets there. For an investor, for investors here, if they were looking at crypto as an asset class, what is the strategy that would you advise to them? How should they be diversifying, putting in money? What research goes into it? What should they be knowing?
I think that's a very important question. And because a lot of time people burn their hands in crypto, it's a very common thing in the previous
people
cycles.
People have burned their hands in equity. I mean, Nilesh told us 89% people don't make money in FNO.
Yeah. So, what needs to happen for crypto investment is you need to change your mindset first. Why the mindset? Because, anyone who is investing in crypto, they have come here for quick investments, quick return, over the night rich scheme. And which is something wrong. What investors need to think is that Bitcoin or any other crypto, there is a fundamental, reason behind it. There's a, hell lot of technological work which is happening, which is going to play out in future. So once you understand that, and if you hold it for long term, there is a possibility that you will be able to create intergenerational wealth by investing in this asset class. So that is one, it's important that mindset change is required. Second, a lot of time the crypto investors are driven by greed and fear. What we also need to understand that what happens in stock market in 5 years is happening in the crypto market every year. That's the speed, that's the volatility. What it means that, of course, the expected return is very high, but it can crash accordingly. It can crash 90%. It can even become zero. So knowing the risk factor is also important. Like last year was a fantastic year. Crypto, the Bitcoin was at 16,500. But very few investors invested. You talk to the Coindcx people. I also have my account with them. And, they did not had a great year in the sense in the 2023, but 2024 is going to be a big year because investors will be coming in the last leg. And so that is something which needs to be avoided. And I think if they approach a portfolio and asset allocation approach, let's say by investing 1 or 2% of the money, which they're okay to lose completely, is fantastic idea. Not going overboard and spending enough time to learn about it is something which is going to help. And generally, time horizon in crypto is very important. Like in equity, we say 5-year plus kind of money. In crypto, you need to have a 10-year plus kind of time horizon. So I think basically it's very simple, not so complicated. You follow the discipline, you're going to make hopefully a lot of money.
All right. Well, I can tell you this, that 2 to 3 years ago when the Bitcoin was declining a lot, everybody said 2024 is the year that's going to be great because of the Bitcoin halving. I mean, everything else kind of worked along, but Bitcoin halving clearly is something that markets are watching out for.
Yeah, well, I'll say this time it's slightly reverse. We normally have a great bull cycle post the halving. We have a great bull cycle that's already come pre the halving, and I think that's primarily driven by the ETFs. And why not, right? I mean, think of the biggest investment banks in the world, right? BlackRock, Fidelity, Vanguard, Grayscale. Everyone's launched a Bitcoin ETF, right? So it just shows the amount of retail participation and institutional participation that has come in to drive crypto to these prices even before the Bitcoin halving. And this is just before the halving. Imagine halving will create another supply gap in the ecosystem. And then we expect, of course, more new highs to happen. Always bullish about the space. So we will always expect that to happen. But as Sir just mentioned, right, every asset class is prone to its volatility. With crypto, it's slightly more. The only thing that we again recommend, and I think that's been the theme of everything that everyone's spoken tonight, is diversification. If you have 100 rupees to invest, I'm not saying put 100 rupees in Bitcoin or put 100 rupees in crypto assets, but whatever risk appetite you have, 10 rupees, 5 rupees, maybe even that 1 rupee, sure, take a punt, and you never know what's going to happen.
How much would you advise putting in cryptocurrencies out of that 100 rupees? How much would you advise putting in cryptos out of that 100 rupees?
So, this is a very tough question. And because every individual is different and, they have their different requirements, the risk profile is different. But for 99% of the investors, 1 or 2% is fine. So because you're not doing it full time, what, someone else will be doing or I'll be doing, we being from an investment space, but 99% of the investors should be okay with 1-2%, which they are okay to lose. By default, it should not hurt them if it becomes 0, but there's also a possibility that it may become 100x in next 10 years. Manisha, I'll just add something. You remember the internet when it came in 90s? You had Yahoo Chat, India Times from, if you remember the people who remember the 90s, people could not envisage that what kind of disruption the internet would do. Today Nilesh Bhai gave, speech to everyone through web conference. There's Amazon, Uber, everything is happening. The businesses are getting disrupted. So I feel the crypto is similarly in a phase what internet was in 1990s. People are not able to envisage the kind of disruption which crypto is going to make in next 10-20 years. According to me, it's going to disrupt the whole of the financial sector. In fact, recently, our SEBI chairman, Madhvi Puri ma'am, said about, how crypto is making young investors go over there. The reason being, today, let's say if you sell crypto, you get money immediately in your bank. When you sell shares, you get after 1-2 days. So now she's saying, okay, from March, we will have a T+0 settlement. And from next year, March, it's going to immediate. So there's going to be a lot of changes. And yes, one should look at that.
You know, when you talk about cryptos, and while of course systematic planning and discipline and SIPs and all of that is great, but most people end up not buying Bitcoin, which is actually the way to go, and go for those cheaper coins which they think you can buy in large quantity and perhaps start earning huge money.
No, exactly. I think this is fundamentally, I think I'll go to what Nilesh sir said, right? There is no overnight success. And that's the same message that we, try to educate even as an organization, even as trying to talk about Web3 in the entire Indian ecosystem. We all need to understand that not every story is a Bitcoin story. Bitcoin at one time, sure, was a few cents. Today it's $70,000. And people expect that every few cent coin is going to move that way and become the next Bitcoin. But that's not really the case. Surprisingly, when we see this, that, is this mentality only related to crypto? It's not. We see the same thing also happening in penny stocks in equity markets, right? People invest in penny stocks thinking they're going to become 100x in the next few years. So I think it's just the mentality of quick money that we need to fix as an investor audience. And fundamentally do some research in trying to understand what lies at the underlying value, right? Is there a technology? Is there any adoption of why that particular token is being used? Or is it just a hype, right? So never buy into the hype, because yes, you could double your money, but you could lose it straight away as well. As simple as that.
Yeah, we can. So final round of questions to both of you. What's your sense going forward from here? The way the cryptos are right now, how would you want to see them evolving so it's easier to invest? How would you look at cryptos going forward from here? How would you want to see them so that it's easier to invest? How would you want to see this place evolve?
That's a very interesting question, Manisha. I think it's a journey which the crypto industry is seeing. And 2024 is a big milestone year with the ETF coming in. There's still a lot of clarity in India that what is the regulatory status of crypto. Of course, government has given a taxation clarity. And, but crypto is a black box in India. I'm being told that there are around 2 crores crypto investors in India, which is a very big number. And it's very important that, these investors are protected. Exchanges like Coindcx and all, they are doing phenomenal work, by doing a FIU transparency and, proof of assets being disclosed. But there's much more required. I think earlier the government comes out with a regulation that will bring more transparency, that will bring more participation. I deal with family offices, HNIs. One of the key reasons why people are not participating, one of the key reasons why there are only $4 billion of assets in the crypto and you have 54 lakh crore in mutual funds is because the large investors, the HNI investors are not participating. It's a more retail. And that's because the regulatory transparency is not there. So I hope that this year government should come out with regulatory for the protection of 2 crore investors and also increase of participation.
There was a question on NFTs, and DeFi seem to be doing well. So every ecosystem, the periphery around blockchain and crypto also is doing great now.
Yeah, absolutely. In fact, I think the talk of the town right now is AI, with great projects like WorldCoin, ChatGPT, all of these coming in. So NFTs is, of course, a natural extension of the Web3 space. It's the future of how people look at gaming. It's the future of how people look at art. And ultimately, all get linked down to the same fundamental technology, which is blockchain. So yes, we are, again, very, very bullish. Not about the crypto space. I think that's an output. If you fundamentally believe in the input, which is the blockchain technology, I think that's what people need to invest in, right? Like one final thought in terms of, when people ask me, we don't understand the technology, we don't understand what's blockchain, how do we, take a call in terms of investing here? But my simple question to them is, many a times, it's okay, you go eat a burger at a McDonald's and you think that's how they make money. Well, in reality, the majority of McDonald's revenue comes from real estate, right? Not from the burger business. So if you ask me what the future of crypto looks like, it might be sitting on your phone. You might be using a game or an app on your phone, but you might not even realize that it's fundamentally being run on a blockchain, right? And that's what you need to invest into. Invest in the technology and not just for the sake of it.
Well, valid point there. Thank you so much, Siddharth, Mukesh. And with that, it's back to you.
Thank you.
Well, thank you so much, Siddharth and Mukesh, for that insightful chat, and thank you so much, Manisha. Before we move forward, we are thrilled to release the Global Crypto Regulation Report, a collaborative effort between Coindcx and Coin Advisory Group. This comprehensive report provides insights into regulatory developments across 18 countries spanning 6 key regions: BRICS, Quad, LATAM, EU, MENA, and APAC. The digital copy of this report will be available on the Coindcx website very soon. You can take a look. Well, with that, it's now time for us to move to a master class. Now, cryptocurrency is increasingly establishing itself as an emerging asset class, gaining traction among investors worldwide. To understand the dynamics of the same, we have with us Lohit Gupta, Assistant Vice President, HNIs and Institutional Business, Coindcx. Let's welcome him with a round of applause.
Hello. Hi everyone. Can you hear me? Thank you. See, my brief before coming onto the stage was simple. Anjali and Sevashri, who have been running the Namaste Web3 series for us along with Forbes for all these time, said कि देखो कुछ भी करो, sales नहीं करनी है. ठीक है? Which for me is a little different because for the last 15 years I have been in sales. But to be fair to Coindcx and the crypto industry, see, we are not traditionally seen as salespeople. Definitely not your snake oil selling salesman, right? It's about technology, it's about application of a technology, and it's about educating people in the application of that technology. So which is why the focus for the masterclass today will be to go beyond the regular trading use cases that the industry has seen very well. For example, a lot of the people here in this audience will call themselves go traders, right? My extended Sasural, by the way, is also in Calcutta. So I get most of my equity tips from Calcutta. It's a different thing that a lot of it was in small cap and mid cap recently. So yeah, even I made some losses. So fair, right? And that's kind of the genesis where we'll start from. So today we'll focus on treating crypto as an investment asset class. And as a lot of speakers mentioned today, as a long-term investment asset class, right? So I'll talk about the last 8 years, I'll talk about the last 5 years, 3 years, 1 year, how the asset class has grown, how you should invest in it, and what kind of alpha you should look at. Can we have the presentation on the stage now? All right, let's go to the first. Thank you. Yeah. I have a marker. Fair. So, although I know a narrative was to spend enough time in the market and not worry about the timing, but I'll start with timing. So the time right now comes from a stage where a lot of those ETFs have gotten approved, where Bitcoin halving is just days away, and the market is buzzing with that interest. Show of hands, how many of you have been following the news and are here because you want to know कि ये और कितना ऊपर जाएगा, right? There's FOMO, right? So fair. See, sometimes FOMO is not bad. FOMO is good till it gets you interested in an asset class, to know more about it. FOMO is bad if you derive all your investment decisions on the basis of FOMO. So I think the previous panelists have covered the ETF part well. I'll take 2 minutes on the halving. Now, I know a lot of you are here new to crypto, which is why I'm not going to get into the technical aspects of halving too much, but understand it very simply. You have an asset which has limited supply, which by its charter will have limited supply. For example, Bitcoin, there is an upper cap to the number of Bitcoins that can ever be mined, right? And every 4 years, you put in a lever there where the incentive for the supply side or the incentive for the mining goes down. So when you are trying to regulate the supply and the demand keeps going up, the asset's price will go up. Simple maths, right? So that's all the halving is about in a very simple nutshell. So, see, we talk about volatility in crypto, right? And Bitcoin has also not been immune to it. But at least the cycles are a little predictable, fair? And see, we've seen a data from, say, November 12 till now. So what we've seen is that, yes, there is normally a peak or an appreciation associated with the halving. And as Siddharth rightly mentioned, this time the peak came in a little earlier because of other factors like the ETF as well. So while I will not put this too much as a prediction, but yes, the swing that you are seeing right now in the market, we're just trying to explain the genesis behind it and how historical data also backs the same. Fair. So we've made up with a few charts and numbers, right? And I'll try and simplify the maths for you. So Mukesh sir talked about 1 to 2% exposure to crypto. Okay? But obviously I'm the crypto guy. I'll take it to 10%. Fair. Again, अपने risk और संस्थानों के अनुसार. Correct? So, for example, look at the blue and the orange graphs comparison, right? So the blue is an investor who had put in 10,000 rupees in only Nifty, right? And we have tracked the year-on-year progress on that. So the final numbers that you see will be as of 11th March 24, right? So if you have entered into the market in 18, 19, 20, 21, 22, 23, this is how your returns would look like. So without promising you too much there, just focus on the orange part of the chart for now. If you swapped just 10% of that investment with the inclusion of Bitcoin, you would almost always turn out to be better placed or more profitable than if you had invested only in Nifty, right? So that is rule number 1 of investing in crypto. Make small changes, small swaps, and start with a low number, 5 to 10% based on your risk appetite, and balance it along with your other investments. Fair? And again, here we look at 1 year, 3 year, and 5 years returns. And yes, as even Mukesh sir mentioned, in the longer run, crypto and Bitcoin are intended to give you better returns than the other asset classes. Okay, now hold on to that number at the bottommost right corner of your screen. A CAGR of 83%, and this is Bitcoin, between 16 to 24, right? Again, no financial guidance, no suggestions being made, but then this is what the data looks like. And we've compared with the Dow Jones, gold, silver, and Sensex. So I agree there is volatility, but if you see it over a period of time, it will always give you significantly higher CAGR than the other asset classes. Now we'll come to the investments part. So when we tried to create a new vertical for seeing crypto as an investment class, there were 2 things that we had to solve for. One was laying out the red carpet. See, I told you I'm the sales guy, right? And my clients are used to कि बैंक वाला बंदा घर पे आएगा, चेक ले जाएगा और अगले दिन अकाउंट खुल जाएगा, right? But we are a digital first company. So one big change for us was how did we cater to these premium customers? So that is where our team came in. We will teach you how to use the technology, how to use our platform, and how to onboard you in the most compliant ways possible that we have made for our platform. So we tell the customers to start with step 1. Step 1 is invest and take an exposure directly on the crypto, right? So just hold on to some Bitcoin, for example. See, all over in my presentation, you will see only Bitcoin mentioned as a representative, right? You should ask me, why Bitcoin? Why not the other asset classes, right? A lot of you have explored altcoins. SHIB kitne logon ne kharida hai? Right? Fair number of people who have taken up SHIB. But okay, I will talk about only BTC, Ethereum, and the other large capped assets. So I'll tell you why. One, yes, this asset class is defined by the underlying. So Bitcoin is known as a store of value. And the other is obviously the analogy to gold, how it is limited supply. And the third and the most significant factor, it has more than half of the market cap, which makes Bitcoin a very solid bet to take on. So when you're starting out, start out with tokens like Bitcoin and Ethereum, फिर धीरे धीरे experiment करो और अपना portfolio बढ़ाओ. Fair? The second part is something known as earn opportunities or yield opportunities. See, the standard expectation is, अगर किसी ने मेरा पैसा रखा है, तो वो मुझे return लाके देगा, right? So again, to give you that analogy, Coindcx as a platform is an exchange, which means it keeps the safe custody of your assets with them. So you will have an expectation that that money should grow and give you steady returns as well. So the earn product or the passive income opportunities is a step in that direction. Now, why does it say that APY, which are annual yields, up to 110%? Hold a pin on that, right? So there are two numbers there, 110% and 12%. 110% is if you consider the INR value appreciation, assuming that the underlying asset or Bitcoin itself has an appreciation over that year, right? So I've taken that CAGR of 80% and then added my returns of up to 12%. So it will give you around 110% growth, right? Sounds too huge? Possible hai, but again, it is risk to market volatility also. So not to be construed as a guarantee. So I'll talk about our premium clients as well, right? Because again, these are very demanding. As I told you, घर पे जाके check sign करवाना expectation होता है. So over the last 6 years, we've had over 15 family offices that work with our platform, around 50 plus institutional investors, including some listed companies that are now engaging with us to figure out how we can solve for their taxation and compliance issues. That's the first task from them. And of course, a lot of HNIs. Without mentioning names in terms of categories, any prominent category, entertainment, sports, or any other that you talk about, we have a lot of HNIs on the platform who have also invested with us. So I'll take a few minutes to go into the product. The idea is to just give you an exposure, and towards the end of my session, we'll take up a very detailed Q&A where you can lay it bare as it is and ask us any questions that you want. See, so this one was to explore that 100+% returns, right? How in INR value, how does it come to that value? So what the maths assumes is that the underlying BTC's value will also grow. On top of it, we are giving you additional returns. So that's how it generates more than 100% return in a year. Understood? But this is as per market conditions as well. I'm sorry, what? Can you repeat that? No, I'll come to that. I got your point, but no, the rupee depreciation is not the value here. I'll explain that maths. So again, you must understand that we are still an early asset class in India, and our products will be a little simple as well, catering to the audience. But we have managed to build in some risk as per the appetite of the customer. So we have a low risk product, we have a medium risk product, and a high risk product. Don't go by the fancy names. And the percentages yields that you see here are in BTC terms to make the explanation simple. And these are based on historic data for the last 3 years that we've running the product. These are the kind of returns that our customers have been able to generate. Again, this is again the INR analogy. Again, the numbers seem high enough. But if you add in my 80% CAGR over the 3 to 6, 4 to 8, and up to 12% returns, that's how your INR returns would look like. Fair? And two disclaimers. One, these numbers are pre-tax figures, right? So you will, again, topic. I'm sure a lot of you have apprehensions about the tax part as well. So I'll give you 3 postulates right now to live with, and then we can go into the depth when we have a Q&A. 1, 30% tax, regardless of the value that you make. B, losses can't be offset. And I know it's a challenge, but then that's how the taxation law sits right now. And the third part is 1% TDS whenever you sell the asset. So the golden law here is tax when you sell, right? So unless you don't sell, you're not liable to pay that tax in its very simplistic definition. Of course, not complete tax advice again, but trying to give you a directional sense. Okay, I've saved the best for the last, right? Is crypto legal in India? ठीक है, what are your opinions? कितने लोग बोलते हैं legal नहीं है? It's okay, मतलब I'm the one being recorded, not you. So, fair. Just a couple of hands, right? So I'll tell you, crypto is definitely legal in India, in the sense that it is taxed as well. Is it regulated in India? It's okay. ठीक है, I heard a mumble. Is it regulated in India? सही जवाब. ठीक है. So let's say it's partially regulated, because every virtual asset service provider in this country, and there are about more than 30 odd players which have applied for the license, come under the financial intelligence unit, which means they come under the money laundering laws, and every platform has a duty to report suspected transactions to the FIU. So at least from the money laundering aspect, FIU has clearly said that they are the regulator for our industry. Fair? So it's partially regulated, agreed, but on the path to get completely regulated. Now there are some milestones that we're trying to capture here. Fair? Feb 22 was when tax came in, while people were happy कि ठीक है थोड़ा legal बन रहा है, but again the structure seems a little high for a lot of people. Then the next one was the FIU point that I've just mentioned, and finally G20 giving an overall acceptance to the directional sense of adopting an international regulatory framework around this. So the narrative is not to be banned, to be regulated, but together across all countries, right? And you all keep reading the news, so I'm not going to quote RFM, but she also recently gave out a very valid statement in terms of how India looks at regulating the crypto sector. Fair. Another important aspect that we will want to touch upon today is, how do you stay safe with crypto? See, if you look at any other financial instrument, right, even the RBI keeps coming up with education of how not to fall into traps around it. So it might seem very obvious, ठीक है, कि हम तो नहीं फंसेंगे, ये तो कोई और ही लोग होते हैं, ठीक है, जो TNC नहीं पढ़ते हैं and Telegram पे कुछ भी click कर देते हैं, and those are the kind of people that fall for it. But you will be surprised at the propensity of even people like us being easy praise to scams in any sector. And yes, crypto has not been touched around unsafe practices there. So here I mean, for example, there can be impersonation. People can build up a website, even copying our name, and promise you astronomical returns. So just a couple of practices of how you can stay safe. One, if somebody offers you money without doing anything, and just for clicking a few ads or some other links, of course, there's something wrong with it, right? Second, please check the validity of the platform that is offering them. For example, check out their website, check out their details. For example, Coindcx as a brand name should be very clear with you. You should go on our website, check our TNCs, and not fall for impersonation games as well. That's kind of what I want to end with. The idea was to keep this a little crisp and light, show you some alpha, but then show you the risks as well, and then take a wider round of Q&A. We have a lot of members of our team sitting here as well, including Mr. Saurav Karmakar. He is from our product team. So I pointed him out for a reason. अगर tech end पे कोई भी दिक्कत है ना, किसी का KYC नहीं हो रहा है, app नहीं चल रही है, Saurav's your guy, and he's based out of Kolkatta. Saurav, एक बार hi कर दो. Right? Fair. So I think I'm done with most of the content. Would love to take some questions at this stage. Fair. Sid, do you want to take that? Can we get Sid a mic too?
So with the regulatory frameworks...
Hold on. We have a question on GST. Let us just answer that.
So there is currently no GST on the asset amount that you're investing, or that is any buy or sell, it's exempt from GST. The GST is only charged on the service fee that the platform is charging you. So let's say, for example, if I charge you whatever commission fees for doing a trade on my platform, I have to charge you a 18% GST only on that commission fee. But on the asset value itself, whatever you are trading, there is no GST at all. Well, honestly, we can have that conversation offline in more detail. We are slightly more expensive than Binance. I would not say we are at the same fees as compared to Binance. That's fundamentally because of the scale of the organization as well, right? Binance is a global player. We are much of an India regulated player. The volumes are much smaller as compared to Binance. But the fees that we offer, if you look at the India counterparts, we are amongst the best fees that is there amongst the Indian counterparts. But on our derivatives offering, we are very similar to Binance. But on our spot offering, we are slightly expensive than Binance. No, not at the moment. Yeah, we want to stay compliant and only work with how, things that we can work and compare with when the regulation for the industry sets in. No. So when you are working in an unregulated space, right, you want to try to mirror what already exists in another industry, right? So if you ask us, there are no KYC laws for crypto platforms in India, right? But today we as a platform follow the same KYC laws that any other equity broker would have, right? So that is how we try to draw our compliances and our regulations by looking at analogy comparisons. And that's how we're not looking at DTs at the moment. Yeah. Honestly, nothing stops us from doing it. It's more about
actually in a crypto rather than a USD.
Yeah.
Somehow the Europeans prefer the payment in USDT vis-a-vis Bitcoin. That's my experience.
Yeah, well, that's where we actually fundamentally differ. And here we are slightly, on lines with how the government thinks about it. If you think about it, government defines whatever you see as cryptocurrencies as crypto assets and not as currency. And that's something we want to harp on a bit more, that we do not expect currency or crypto to ever be a legal tender in India. It will always act like an asset class. And that's why we will not even want to go down the, drain where we try to make it operational as a currency, right? Because that undermines the value of the rupee, which is the fundamental core of what the economic system sits on. So yeah, that's my take to it.
Thank you. Thank you, Siddharth. Thank you so much. There was a question at the back there. Can we give him the mic? Yeah, thank you.
So, considering there's a lot of volatility still in the market with respect to crypto and the legal framework and the taxation, don't you think investors, especially retail ones with not large corpus, should wait for at least a year or two and then start investing? Because it's still very risky for retail investors. And if you want an exit after like 6 months, you don't know, in case of emergency, it might be 80% down. You're saying it still needs to wait for 4 years, 5 years. When we compare it to equity, like we can still take an exit with a 20%, 30% max negative. So don't you think we should wait for 2-3 years and then start investing in cryptocurrency?
Okay, fair point. I'll give you just 2 or 3 dimensions to that. One, again, our world will also see your large cap, small cap, mid cap, right? So again, as per the risk appetite, you should enter at that stage. Second, in terms of exit, figure out how easy we made exit for our customers, right? We're 24/7 at the click of a button. So you can put in as much as you want. In fact, we have an SI, similar to an SIP product also, right? Where you can put in significant, small amounts of money at frequent durations of time. And the second, withdrawals are very easy. So for example, we are instant settlements, right? You click a button right now, the money will be in your bank account in 5 minutes. That's how fast we are. So I would say, while I hear you, but crypto is now not new in India, right? We've been here more than 6 years. The industry has been through a lot, right? There is a tax policy also around it. So a lot of that maturity has already happened. So our fundamental charter was Indians not missing out on this opportunity, and we believe in the underlying technologies as well. So the right time definitely is now. I think we are still much more matured than initially, and platforms like ours are making that difference. Fair. Any other questions? Raghav sir, yes.
How do you value that? Because it's so, volatile, right? So how do you actually know when to buy or sell as a consumer? So, because in equity markets, I can track it. In unlisted, there are like cash flow statements and stuff like that. In this, how do you actually track it as an investor?
Fair. So I'll give you a small, runner to that and divide this question into two parts. One is, the fundamental question is, what is the underlying asset first, right? And that is a question all of you will have. So there, I'll say that the use case itself kind of justifies the underlying value that it has. For example, BTC, as I said, is a store of value. In its fundamentals, it was always supposed to be a transfer of, value as well. Will it get there? How will it get there with regulation and with time? That still remains to be panned out. The second part, if I got your question right, is how can a retail investor be able to track the variation of this underlying asset, right? So do you want to add 2 lines to that?
That exist, and one honestly do not have a fundamental value to it, right? And we in the crypto world call them as meme coins, right? You have Shiba Inu, Pepe, Bonk, and honestly there is no underlying value to it, and that is why we refrain from asking people to invest in those as well. But if you look at the more fundamental crypto projects, like let's look at Ethereum, let's look at Chainlink, Cardano, Solana, all of these are actually technology companies where the coin is just an output of the work that they do. And all of these companies do have their quarterly financials that come out as well. You can understand what's the industry PE for a particular technology. You can understand what's the PE of that particular entity. You can understand what is the 52-week high, 52-week lows. You can understand what are their quarterly results, how much revenue they are making, how much profits they are making, what's the team size. All of these details are actually available. It's just unfortunately lack of education that's there. Like you have websites like Money Control, you have TradingView, you have Chittorgarh, you have so many other places where in equity you have that transparency of data and you know that these data points are available. In crypto also you have these data points, right? You have Glassdoor, you have Chainlink, you have CoinGlass, you have CoinGubber, right? There are enough third-party sites who are aggregators of this financial information, and retail investors can actually check into those. They can check when was the last price action of any crypto asset and what PE was that at versus what PE is it trading at today. Is it overpriced? Is it overbought? All of these things can actually happen for crypto assets as well, as long as you're looking at the fundamental companies actually building on blockchain. If you look at the other tokens which do not have any underlying technology behind it but are only used as maybe a trading asset, then the story is very, very different. It's very difficult to then have a fundamental thesis to it.
There was another question in the middle, I guess. Yes, please.
Hello. Yeah, so I was wondering that, yesterday or the day before our FM has said that India is not looking at crypto as a legal currency. So it's just an asset, it's just an investment asset. So given that India is looking at crypto just as an investment asset, still the taxes are very steep. Like globally also, if we see, very few countries have taxation as steep as India in case of cryptocurrency. So given that the acceptance that G20 has given to crypto, do we see or can we expect the taxation to go down a bit with time, bringing it at par with its global counterparts?
Okay, I was trying to avoid a policy question, but those will come. So yeah, if you see the news article that you're talking about, right, it differentiates both use cases. It says as a currency, the government never wants to accept it, but any other use case or a trading use case, you know, as an asset or an investment class, people are still doing it and they're kind of fine with it, right? When you talk about taxation, yes, agreed, it's a steep tax, right? But it's a step in the right direction and things have just started. If you saw my chart, it's not been a long time since tax has been imposed on that, right? So while Coindcx as an organization have been trying to figure it out, try to, you know, talk to the lawmakers as well, but it will be tough for me to give you a definitive answer of how I see this evolving and TDS kab kam hoga, tax kab kam hoga. Ye सब मत बुलवाओ. So my point is tough to give you a clear answer there. But yes, as an organization, we are definitely trying to get that addressed as well. Anjali, yeah.
And while people are investing in crypto, you've seen how FIU had banned, Binance and all, because those were foreign exchanges. So BWA, which is an association, and we are working very closely, all the exchanges are working very closely with BWA, and we've made a lot of submissions to the government, to the policymakers, telling them that eventually, you know, they also earn because there's a TDS to it, and investors will not stop investing. So the recent Chainalysis report says that India stands #1 in crypto adoption. So, you know, government should consider reducing tax, and that's what all of us are, you know, hoping for and trying our very best to do that.
Thank you, Anjali. Any more questions?
We get a lot of offers of ICOs we keep on getting because we have been crypto investors for quite some time.
See, I hear you, but let's take this a little offline. Because see, again, as a platform, you have to be conscious about what kind of risk appetite you want to offer your customers. I'll give you a simple example. Even the tokens that we list on our platform, there are thousands of tokens in the ecosystem. But our team follows a 7M listing framework where every token is evaluated, its white paper, its use case, who are the people behind it. And then we go ahead and list the token on the platform. So I hear you and you're an evolved investor. For our general user base, we would like to be a little more conscious of the kind of opportunities that we want to expose them to. Fair?
But that's where you make the real money in crypto.
It's about making the responsible money, responsible real money in crypto, right? We would like to stand for that. Fair. Thank you so much. I would also like to mention that we have a table set outside where our team members will be there to answer any of your queries. Of course, I am there, Siddharth is there, Arun's there. Arun heads our VIP program as well. So we'll love to take your questions out on the desk as well. Thank you so much. Back to you.
Thank you so much for that informative masterclass. Well, with that, ladies and gentlemen, we come to the end of what has been an evening filled with so much learnings and sharing. Thank you for being such a wonderful audience. Please do join us for dinner.